Hello traders, welcome to our next video of Prime Connect training class. In today's video, let me explain one of the first trading strategies that is commonly used by traders. Yup, the trend following traders. But first, let me introduce myself. With me again, Donovan. I'm an analyst and trader of Prime Connect. I'm experienced in trading for 9 years. And disclaimer, all information is being presented for educational only purposes. Any information in this video should not be construed as containing investment advice or investment recommendations. Alright, let's dig in. Understanding the trend following strategy. The trend following strategy operates on the premise that markets tend to move in sustained trends over time. This strategy involves identifying the direction of the prevailing trend, upward or downward, and entering trades in alignment with the trend. There are two types of trend following strategy. First is systematic trend following, and the second is discretionary trend following. Let me explain it to you. Systematic trend following involves trading. Systematic trend following is a popular trading strategy in the forex market that aims to capitalize on sustained price movement by identifying and trading in the direction of established trends. This strategy relies on predefined rules and technical indicators to determine entry and exit points, minimizing emotional bias and increasing the potential for consistent profits. Let's get some practice and see how it works. Trend identification. Systematic trend following starts with identifying the prevailing trend in the forex market. This can be accomplished through the use of various technical indicators such as moving average trend line and trend channels. Entry signals. Once a trend is established, the strategy generates entry signals based on predetermined criteria. For instance, a common approach is to wait for a trend confirmation after a minor retracement or consolidation period. Traders might use a crossover of two moving averages as an entry signal. Position sizing and risk management. Before entering a trade, traders determine the appropriate position size based on their risk tolerance and the size of their trading account. Risk management techniques such as setting stop loss orders to limit potential losses are crucial in this strategy. Exit signals. Exit signals are equally important. These can be generated using various indicators such as trailing stop, moving average crossovers in the opposite direction, or trend line breaks. The goal is to capture as much of the trend's movements as possible while minimizing losses if the trend reverses. Okay, now about the good things and the bad things of systematic trend following. Let's talk about the good first. First is objective rules. Systematic trend following relies on predefined rules, reducing emotional decision making and improving consistency. Right trends. This strategy allows traders to capture significant portions of trending market movements, potentially leading to higher profits. Risk management. Clear entry and exit rules along with proper risk management techniques help protect traders from large losses. Diversification. Trend following can be applied to various markets and time frames, providing opportunities for diversification. Now, we should know about the bad ones. Whipsaws. During periods of market volatility or when the trends are short-lived, forces that can result in whipsaw losses. Delayed entries. Trend following strategies may result in entering trades after the initial trend movement has already occurred, potentially missing some profits. Flat markets. Trend following strategies may struggle in flat or ranging market, leading to false signals and losses. Mechanical nature. The systematic approach might not consider fundamental factors that can impact the forex market, potentially leading to missed opportunities. Alright, let's move to the second type. Discretionary trend following involves trading. Unlike systematic or algorithm approaches, discretionary trading involves making trading decisions based on traders' personal judgment, experience, and analysis of market conditions. This strategy requires a deep understanding of technical and fundamental factors influencing currency movement and allows traders to adapt to changing market conditions in real time. Okay, brace yourself and get some practical. How to use discretionary trend following. First, identify trends. Traders start by identifying trends in currency pairs using various technical analysis tools such as moving average, trend lines, and momentum indicators. They look for consistent patterns of higher high and higher low in the uptrend or lower highs and lower lows in the downtrend. Analyze fundamentals. Discretionary traders also take into account fundamental factors such as economic data releases, geopolitical events, and central bank decisions. These factors can provide insights into the underlying drivers of currency movements. Chart analysis. Traders study price charts to identify potential entry and exit points. They look for confluence between technical indicators and support resistance levels to make informed decisions. Risk management. Effective risk management is crucial in discretionary trading. Traders determine their risk tolerance, position sizing, and stop loss levels to protect their capital from significant losses. Entry and exit. When a trader identifies a potential trend, they enter the trade based on their analysis. Stops and targets are set based on technical level of market volatility. Traders can also adjust their position or exit trades if market conditions change. Now, let's talk about the good and the bad. The good. First is flexibility. Discretionary traders can adapt to changing market conditions, news events, and unexpected developments. Second, experience base. Traders with years of experience can leverage their intuition and insights gained from studying markets. Third, real-time decision making. Discretionary trading allows traders to make decisions in real time, which can be advantageous in volatile markets. Fourth, individualized approach. Traders can tailor their strategy to their own strength, risk tolerance, and preference. Let's get the bad. First is emotional bias. Emotional decision making can lead into impulsive trades and inconsistent results. Subjectivity. Different traders might interpret the same data differently, leading to inconsistency in strategy. So, learning curve. Mastering the art of discretionary trading requires a steep learning curve and extensive market knowledge. Time-consuming. Analyzing chart fundamentals and making real-time decisions can be time-consuming and mentally demanding. Okay, now maybe you're wondering how we use this strategy in the bearish and bullish market. Well, stick to me and let me explain this to you. Trend following on bullish market in forex trading. To identify a bullish trend, traders often use indicators like moving average, the RSI, and trend lines. We have talked these indicators in the previous videos. I'm not talking too much about how you determine the bullish market. I will focus how to use the trend following on bullish market. Let me explain it to you with practical explanation. Entry. Once a bullish trend is identified, traders may enter the market by buying the currency pair at a favorable price pair, such as pullback to key support level or moving average. Stop loss. Traders could place a stop loss order below the recent low or key support level to protect against potential reversals. Take profit. Set a target price where you plan to exit the trade and take profits. This could be based on resistance levels, previous highs, or other technical analysis tools. Okay, let's see the good side and the bad side using this strategy in the bullish market. The good things are ride the trend. Trend follows allow traders to capture significant gains by staying with the prevailing trend as long as it lasts. Simplicity. The strategy is relatively simple to understand and implement, making it suitable for traders or various exposure levels. Reduce emotional trading. Following a systematic approach reduces the impact of emotional decisions, leading to more disciplined trading. The bad things in bullish market. Delayed entry. Trend following strategies might result in entering a trade after the trend has already begun, missing out on some early gains. Whipsaw markets. In volatile or sideways markets, trend following can lead to false signal and losses to sudden reversals. Drawdown. There can be periods where the market experiences temporary reversal or pullbacks, leading to potential drawdowns before the trend resumes. Okay, let's move to the bearish one, also with practical explanation. Trend following on bearish market in forex trading. Trend following is a trading strategy used in the forex market to capitalize on prevailing market trends. Even in bearish conditions, in a bearish market where currency prices are generally decreasing, trend following involves identifying and trading in the direction of the established downtrend. Identify the trend. Analyze the price chart to identify a clear bearish trend characterized by lower highs and lower lows. Entry points. Wait for pullbacks or retracements within the bearish trend to find suitable entry points. These could be areas where the price temporarily moves higher before continuing its downtrend. Confirming indicators. Use technical indicators like moving average, trend lines, and momentum oscillator to confirm the strength and sustainability of the bearish trend. Setting stop loss. Place the stop loss at or above the recent swing high to protect your position from potential reversals. This helps you manage risk in case the trend reverses unexpectedly. Setting take profit. Set take profit level based on key support levels, previous low or technical indicators that suggest potential price targets within the bearish trend. Okay, now let me tell you the good things and the bad things of using trend following in bearish markets. The good things in bearish market. First, capturing downtrends. Trend following allows traders to profit from sustained bearish movements by entering trades aligned with the prevailing trend. Simplicity. The strategy is relatively straightforward and can be implemented using basic technical analysis tools. Risk management. Placing stop loss order helps manage risk by limiting potential losses if the market reverses. Long-term potential. Trend following strategies can be profitable over the long term, as trends often persist for extended periods. Now, we learn the bad things in bearish market. False signals. Trend following strategies can generate false signals during period of consolidation or when the market is exponentially volatile. Late entries. Trend following strategies may result in entering trades after a trend has already been established, leading to missed profit opportunities. Whipsaws. There's a risk of getting caught in a whipsaw movements, where the market briefly reverses direction before continuing the original trend. No predictive power. Trend following doesn't predict market reversal or turning points. It only identifies and follows existing trends. Besides the cons in a bullish or bearish market, the trend following strategy also has some limitation. Here are some points. Lacking nature of trend identification. 2. Whipsaw and false signals. Limited effectiveness in ranging markets. Drawdowns during trend reversals. Emotional challenges and impatience. Dependence on historical patterns. Over-optimization and curving feeding. Risk of missing counter trend opportunities. High capital requirements, and the last is limited adaptability to changing market conditions. Well, I think that's enough for trend following discussion today. See you on the next video. Goodbye.